Welcome to the ASIS Economist Board, where we discuss the current economic environment as it relates to industrial production. Each of our industrial production models incorporates data from approximately 18 to 20 economic indices, with data going back over 20 years. In this video and in the 7 related subsector videos, we'll dig into what is driving each of our forecasting models and relate it to what we're seeing in the real world. More importantly, where we see things are headed and why. I'm John Nelson from M&A, and I'm joined today by both Keith Prather and Chris Keel of Armada. So you guys ready to go and talk about industrial production?
We are.
Yeah.
Nothing
right.
I enjoy more.
All right, here we go. So I'm going to go ahead and bring up the models. And of course, my screens are not cooperating with me. They're every place that I don't want them to be. But okay. So industrial production for manufacturing, this is our current forecast. And as you can see, one of the things that I wanted to kind of mention here is it looks a little bit more positive than last time. From our using the November data as opposed to the October data. But the one interesting things that we've seen is that a lot of these stay well within that cone of variability, if you will. And if you look at that long-term forecast as we're seeing it right now, if you look at the upper band of our last month's forecast, it almost mirrors it. So again, that's why it's so important to understand that these are forecasts and then they've got some variability associated with it. One thing from the number standpoint, that what kind of swing is that? Well, you're really looking anywhere from about a 3 to 5 point swing all the way on 18 months from what we were predicting before. So that's what I'm seeing from the number standpoint. Anything jump out at you, Keith?
Well, I mean, the one thing we talked about off camera is, that there's some things like wholesale inventories and the challenges along the supply chain and trying to rebuild enough inventories that a lot of manufacturers can get their full assembly lines rolling. The one thing that's different, and I'll have Chris weigh in here in a second or two, but we heard like 6 months ago that a lot of manufacturers were missing maybe 4 or 5 or maybe 20% of the components that they need to be able to crank a product out. And now they're at a point where the inventory levels, if we look at the inventory to sales ratios, their inventories are up. So they've been able to rebuild some of those inventories, but they're still missing like a key component or a microchip or something that keeps output down a little bit lower than it probably should be. Because like when we look at the other 7 sectors that we're going to go through in the models, you're going to see that some of those sectors are up 20% year over year. And we expect them in 22 to be, growing at double digits, but we still see a little bit of a flattening or a little bit of a weakness in this particular part of the curve. So it can be a little bit confusing, but overall, it's still a positive trend.
Mm-hmm.
I don't know, Chris.
And here's my color commentary. I'm going to play the role of the retired jock that comes in periodically and tells stories. I've been on the road for the last several months and have been kind of testing this against people that I'm meeting at these meetings and trying to say, does this resonate with you? Or are you seeing these kind of performances with your company and your sector? And one of the things that jumped out was the strategy that these companies have been adopting over the past several months to a year, trying to figure out what supply looks like, what demand looks like, what the impact of the next virus surge is going to be, et cetera. And there were 2 options, each of them bad in their own way and good in their own way. And I think that they're sort of affecting what we're seeing with IPMAN. Option 1 was to assume that this inventory was not going to be sufficient and demand was going to be continuing into 2022, and that they had to pull out all the stops and do whatever they could to meet that demand. They'd have to add people, add machines, hoard as much as they possibly could of every part they think they ever would need, and then hope that at some point that demand does justify all that investment. The downside, of course, is if the demand doesn't, then they're stuck with all that inventory. Bad, good option number 2 was to say, I don't believe all this is going to happen in 2022. I think we're going to continue to have problems. I am not going to spend on inventory. I'm not going to hire people. I'm not going to buy machines. And then they sat back and watched their competitors gobble up market share. So these companies are, they're literally looking at each other like, so you did the opposite of what I did. How are you doing? and they're almost having a fight over, you know, which is the ideal option. And it's going to sort of depend on the future. If the demand really does hold, those that have been accumulating inventory will do fine. But if it drops off, like some of our models indicate, then the ones that were being super cautious are going to say, yeah, well, I lost market share, but I'm still here.
I think the simple question that I think probably on a lot of people's mind, because it's all over the news, and me being the neophyte looking at the news every day, you can't help miss that one, inflation is rising and is expected to continue to rise for the next year. And two, there's increased pressure on the Fed to start raising interest rates. How do you guys see that putting pressure on industrial production?
Well, I think the critical thing with inflation right now is to understand that the reason that we're getting it is supply chain and money supply. Both of those will begin to right themselves by the beginning of next year, because most of the predictions on inflation are that we're near peak now, and then it's going to start coming back down. An awful lot of the inflation has been related to supply chain, and that which hasn't been related to supply chain is still that hangover of all the extra money that was circulating in the economy. I think what's got everybody concerned is that there's one kind of inflation that if it gets going doesn't recede, and that's that wage price chase, where you get prices going up and then people start demanding wages go up to meet the high prices, which means that the producers end up raising the prices even more to deal with the higher wages, which prompt people to ask for more wages to deal with the higher prices and more wages and more prices. And you get that chase, which is what set up the big mess back in the 1980s. And the only thing that could control that was Paul Volcker jamming interest rates up to, I don't know what it was, 18,000% or whatever he did. I mean, it was that's the thing that makes people nervous. We're not yet really seeing it, but it's kind of over in the corner, threatening to come out. So
let's take a quick look at the long term. Different than but before, it now looks like a little bit more close to being on trend, just a little dip below trend right now, but basically following the trend line in that general area. Any comment on the long run from that overall 20-year perspective?
Yeah, I mean, I think it still is obviously showing a little depression there. Not depression in the classical sense, but it is depressed from you know, what we saw prior to the pandemic. You know, a couple of things here too, as Chris said. I mean, it really is about the supply chain getting back in cycle. You know, right now, from like a raw material perspective around the world, we see inventories of some of the critical raw materials that go into a lot of these supply chains starting to hit at least 10 to 20-year lows. Prices are starting to surge on the other side of that, and we just don't see a lot of recovery in the commodity side of at least this part of the equation. And so again, you know, going back to what Chris said, I think a lot of purchasing managers and a lot of these you know, production schedules are basically being held back because they don't want to buy commodities when they're at all-time highs. And so they're kind of going through and resting on whatever inventory strategy they've taken, and, you know, feeding off of existing inventories. And then sometime next year, we get into Q1, Q2, then they'll start figuring out kind of what the landscape looks like and what they've got to do to rebuild kind of going into the rest of next year. So seeing this depressed a little bit now, I mean, I do think you'll start to see this start to improve. I think the outer curve, the other end of the curve itself, the 18-month side of it, I think will start to improve over time, because I think demand still, you know, remains strong.
yeah, we don't talk about oil specifically when we go through all this stuff, but just again, as a understanding where the producers' heads are at right now, and this would go for copper and steel and all the others. I was talking to some oil guys in the Dakotas, and I said, you guys ought to be just loving life right now because there's such a huge demand and you could just go into full production. They said, well, here's the problem. We're not seeing our real demand come back. We know what drives demand in this country, and it is the commute. It is people filling up their cars to go back and forth to work. And we realize that only about 40% of people are, they're working remotely and they're not getting back to the commute. We look at the things that are driving oil prices now. It's gas prices in Europe because the Russians are fighting with the Germans over Nord Stream 2, and it's a lack of wind, and it's this. Every one of those could end as a problem in an hour. If suddenly the Russians said, okay, fine, we've made our point, we're going to ship gas, or the Germans say, okay, fine, and we don't want the pipeline, we also don't want to freeze to death, let's go ahead and approve it. And the oil producers are saying, the second that happens, demand drops. And we're sitting there like, oh, so why did we boost production when there wasn't any real reason to boost production? And I think that's what Keith it's the waiting game. It's like,
Yeah.
Yep, I should produce given the demand right now, but is that demand, I mean, it's kind of like a retailer saying, yeah, I could bring in stuff for Christmas now. Do I want to bring it in February? No.
Yeah, we've got a number of forecasts that are out now from a lot of different organizations, some global organizations saying that they believe that investment in this sector, to Chris's point, because they can't measure demand, and they also are kind of worried about a green future, investments so far are down 25% across the entire oil sector over the last 2 years. And we're seeing projections like out of the International Energy Agency that's showing that continuing like through 2030. So, who knows where this is going to go? You got some firms out there that have a lot of reasons to make predictions like this, but you got JP Morgan saying basically $125 per barrel oil, maybe for the foreseeable future. And of course, I think they've probably been 180, 190, 200, probably 10 times over the last 5 years, but
yeah,
we'll see what happens.
Yeah.
Well, and I think to Keith's point, I mean, it's important for people to recognize that a lot of data is issued with intent, and if you're trying to influence markets and influence companies, I mean, one of the things the oil sector has been doing is kind of looking at all the electric cars and this, that, and the other, kind of going, well, go ahead and invest in all that alternative stuff, but that means that we're not going to invest, and you better hope that comes up with the power you need. And then they point to the Germans and Europeans and say, so how'd those wind farms work out for you this year?
Yeah.
The wind didn't blow. And yeah, that's the problem with these renewables. They're not as reliable. Setting fire to a rock is always going to work better than hoping the sun shines.
Gotcha. Okay, so then we got, here's our year over year, and I'll point out, it's the dashed red line or brick colored line that you're looking at. From here, it's where I'm tracing my mouse. That is the, sorry, that's not that one. This one is 2021 forecast, the last part of this year. And then down here, this is our 2022 forecast. Anything stand out to either one of you? Other than it looks like it's right in the mix to me.
Yeah, I mean, I hope people will tune in to the other 7 subsectors, because I think you're going to see some nice growth in some of those subsectors, some of the durable side. So automotive machinery, aerospace, even primary metals and fabricated metals. I hope they'll tune in, because those are interesting growth metrics, if you will. And this is still reflecting, again, the combination of both durable and non-durable manufacturing. And like you said, I mean, it's average, it's fairly stable.
All right, well, guys, that concludes IPMAN. And so I hope, as Keith said, that you all join us for our next 7 subsectors, and we look forward to you again next month.
All right, take care.
Bye-bye.